Hey, Asian guy here. I've spent years watching financial markets from the inside out, and if there's one thing I've learned, it's this. The biggest moves rarely show up in the loudest headlines. The real game is usually quiet, boring-looking, and brutally effective. So let me hit you with a question. What if I told you that while everyone's been distracted by trade war headlines, election drama, and whatever political soap opera is trending this week, China has been calmly running a strategy that could reshape the global economic order? And here's the kicker. Most people, even a lot of experts, don't even realize it's happening. We're not talking about tanks rolling across borders. We're not talking about a flashy summit or a treaty signing that makes the news cycle. This is way more subtle, way more patient, and in the long run, way more powerful. China is systematically cornering the market on the physical resources that power modern civilization, and the implications for your savings, your investments, the dollar in your wallet, and basically the entire next decade, are insane. Before I dive in, I need you to understand something. What I'm about to share isn't conspiracy theory. It's not fear-mongering. It's not trust me, bro. It's documented strategy, backed by billions of dollars in real transactions happening across global commodity markets, right now. And once you see the pattern, you can't unsee it. So stick with me, because by the end of this video, you're going to understand the real game being played while everyone else is watching the distraction. Here's what's actually happening on the ground. China isn't just the world's factory anymore. That's old news from 20 years ago. They evolved past cheap manufacturing. What they've become is something more strategic, and honestly, a lot more dangerous to Western economic dominance. They're positioning themselves to control the supply chains for nearly every critical material modern technology depends on. And I'm not exaggerating when I say every. Semiconductors that power your phone and laptop. Solar panels everyone says are the future of energy. Electric vehicles governments are mandating. Defense systems that protect nations. Aerospace technology. Advanced manufacturing. Medical devices. All of it needs specific metals and rare materials to function. And China is locking down global supply at a pace that should be setting off alarm bells in every Western capital. Just sit with the logic for a second. If you control the raw materials, you control who can manufacture. If you control manufacturing, you control prices. If you control prices, you control economies. It's not complicated. It's actually beautifully simple once you zoom out. And Beijing has been playing this long game for years. While Western nations obsess over quarterly earnings reports and election cycles, China's running a comprehensive national strategy to secure industrial metals across the entire spectrum. Rhodium, essential for catalytic converters and chemical processing. Palladium for electronics and hydrogen fuel cells. Platinum for everything from medical equipment to petroleum refining. Rare earth elements. Sounds exotic, but they're critical for magnets in wind turbines and electric motors. Copper, the backbone of electrical infrastructure. Lithium for basically every battery tech. Cobalt for battery stability and jet engines. Nickel for stainless steel and battery cathodes. And dozens of other materials most people have never heard of. But civilization literally can't function without. And this isn't just opportunistic buying when prices are low. This is systematic, strategic stockpiling, often through state-owned enterprises, backed by government policy, and effectively unlimited funding. The scale is hard to comprehend until you add up the numbers. Billions deployed month after month, year after year, with singular focus. And the evidence is everywhere once you know what to look for. Unusual price moves in obscure metal markets. Chinese companies outbidding Western firms for mining rights in Africa and South America. Massive increases in Chinese metal imports even when manufacturing output looks flat. Strategic reserves being built that dwarf what Western nations maintain. And on rare earths? China already controls something like 70% of mining and around 90% of processing, separation, and refining capacity depending on the estimate, which is the real choke point. Not mining, processing. Even if rare earths are mined in places like Australia or the US, they often still get shipped to China to be processed, because the expertise and infrastructure is there. Those elements, neodymium, dysprosium, people butcher it as diprosium, terbium, you'll hear terbium. They're critical for everything from smartphone components to missile guidance systems to MRI machines. Without them, modern tech doesn't just get expensive, it stops working. And now they're expanding that same dominance across other categories of metals systematically. Because if you control the materials, you don't just control manufacturing. You control innovation itself. You control which countries can build advanced industries, and which ones are dependent on you for permission. That's economic leverage that doesn't require firing a shot or signing a treaty. It's power from patient, strategic positioning. Now here's the part most people completely miss. And this is where the financial market shadows really show up. Every single dollar China spends buying physical resources is a dollar they're converting out of US currency and into real assets with intrinsic industrial value. Think about what that means. They're dumping paper for tangible materials with real utility. China accumulated massive dollar reserves for decades by running trade surpluses with the West. Now they're methodically converting those reserves into the literal building blocks of future technology and industry. In terms of consequences, this is one of the biggest and most consequential wealth transfers in human history, happening in plain sight while everyone's distracted. Let me ask you something. If you had $1 trillion in a currency that's being printed into weakness, what would you do? Would you keep holding paper, or would you convert that paper into physical assets that hold value and give you leverage? China chose option 2, and they're executing it with ruthless efficiency. And the tariff policies that have been implemented over the past year, they've actually accelerated this trend in ways a lot of people probably didn't intend. If trade volumes between the US and China get reduced, fewer dollars flow into China through normal commerce. So what's Beijing's response? Panic? Beg for a trade deal? Not even close. They adapt like long-term strategic thinkers. They trade less in dollars and increasingly in RMB, renminbi with global partners. They use existing dollar reserves to aggressively buy resources before those dollars lose more value. And they build alternative trade and financial systems that don't depend on Western infrastructure or Western rules. And if you think this is just economics, you're missing the bigger picture. This is about global power, and it hits the dollar directly. The US dollar is already on track for its worst year since 2017, down around 8% against a basket of major currencies. And when I say the dollar is weakening, I'm not talking about normal day-to-day noise. I'm talking about a structural shift, driven by changes in global trade, reserve behavior, and capital flows. Options traders on Wall Street, the people who literally get paid to bet on currency moves, have been leaning bearish on the dollar. And there's a reason you need to understand. Dollar down cycles driven by structural factors, not temporary sentiment, historically last 5 years or more once they begin. This isn't a dip that magically fixes itself in 6 months. This is a multi-year trend, and we might only be in year 1. If you're finding this valuable and you want to stay ahead of these trends, do me a favor and hit that subscribe button right now. I spend serious time researching deep structural shifts that mainstream media either misses completely or dumbs down into useless sound bites. Your subscription genuinely helps me keep producing this kind of in-depth analysis. So click that button. Now let me show you a perfect real-world example of what I'm talking about. Look at the silver market. Silver prices have gone absolutely parabolic over the past year, trading well above $76 per ounce and even spiking into the 80s. If you bought silver at the beginning of 2025, you'd be sitting on roughly 150% gains. That's not normal. That's not gradual appreciation. That's supply shock meeting insane demand. And here's what most people don't understand. Silver used to be treated mostly like a monetary metal, coins, store of value, with some industrial use, but it has evolved into something governments increasingly treat as strategically critical. Why? Because silver is essential for advanced semiconductor manufacturing. It's needed for solar panel production at scale. Defense systems depend on it. Aerospace depends on it. Modern medicine uses it. The electrical grid needs it. Without enough silver supply, entire industries grind to a halt, and the supply-demand problem is simple. Mining production isn't keeping pace with exploding demand from competing sectors. Too many buyers chasing not enough physical metal. Basic economics says prices rise, but here's where it connects back to China, and this is where the market's dark corners really show themselves. The single biggest shock to the silver market right now is coming from China, and what's happening there reveals the psychology of a nation waking up to resource scarcity. Chinese investors, institutions, and retail figured out something Western markets don't like to say out loud. In paper silver markets, futures contracts, ETFs, synthetic products, there can be more than 100 contracts claiming ownership of silver for every single physical ounce that exists in vaults and can actually be delivered. It's basically fractional reserve banking applied to precious metals. Once you understand that, the rational response is obvious. If you want real silver exposure, you buy physical metal and take delivery. You don't trust paper promises when the ratio might be 100 to 1. And that's exactly what's been happening in China, at a scale that's causing real disruption. Everyone wants physical, bars, coins, something they can hold, not paper, not exposure, metal. Demand has exploded so hard that legitimate shortages have been developing in China's domestic physical silver market. Let me give you numbers that show how crazy it got. Silver investment funds in China have been massively oversubscribed beyond historical precedent. The UBS-linked silver fund situation became so saturated that people were paying around 60% premiums over the net asset value of the silver exposure inside the fund. Read that again. People were paying 60% more than the underlying value, basically paying $160 for $100 worth of silver exposure just to get in. Now please note, everything I'm sharing is strictly for educational and informational purposes only. This is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult qualified professionals before making any investment decisions. Financial markets are unpredictable, and past performance never guarantees future results. And yes, obviously, that 60% premium is extremely dangerous. If the premium collapses back to zero, which it eventually will, investors could face catastrophic losses even if the underlying silver price stays flat. That's reckless speculation by any measure. But here's what that behavior reveals about reality on the ground. 2 critical facts. First, physical silver supply in China got so tight people couldn't acquire metal through normal channels at any reasonable price. The shortage is real and severe. Second, investors are genuinely afraid they won't be able to acquire any silver in the future, regardless of price, so they front-run. They pay whatever it takes today, hoping prices keep rising fast enough to justify absurd premiums. That's fear-driven buying, and fear is a monster in markets. The premium between Chinese domestic silver prices and international prices shows how extreme it got. Silver traded above $80 per ounce in local Chinese markets, roughly 10% higher than global spot. In a normal, efficient market, that arbitrage gap gets instantly exploited. Metal moves from low-price regions to high-price regions until prices equalize. The fact that the gap persisted, and even widened, tells you physical supply constraints were so intense that normal arbitrage mechanisms started breaking down. Now I'm going to be completely honest and balanced with you. What's happening in Chinese silver markets turned into a speculative mania. And mania can't last forever. There's a real probability of a sharp correction at some point. Some corrective selling has already been happening as I record this. What we're witnessing is not calm, rational, efficient market behavior. It's speculative excess, fear and greed at the same time. But And this is crucial. Underneath all the mania, there's a real fundamental story that isn't going away. Chinese industries and Chinese investors are absorbing massive quantities of physical silver because they see its strategic importance. They get that silver isn't just a trade, it's access to an essential material for technology, manufacturing, and national strategy. And here's the insight that ties everything together. Silver is just one visible case study of a much larger phenomenon. This exact dynamic is playing out across industrial metals and critical materials at the same time. China isn't stockpiling silver in isolation. They're securing the periodic table needed for modern industrial civilization. Copper for electrical infrastructure, lithium for batteries, cobalt for stability, nickel for metallurgy, rare earths for magnets and electronics, manganese, yeah, I've even heard it joked as manganeses, for steel production, chromium for stainless steel, tungsten for industrial tooling, molybdenum, people misspell it as molybdenum, for high-strength alloys, vanadium for energy storage, gallium for semiconductors, germanium, sometimes mangled as duranium, for fiber optics, indium for touchscreens. The list goes on and on. And it wouldn't surprise me at all if state-owned enterprises are quietly accumulating billions of dollars worth of these materials, billions of ounces across various metals, in quantities that never show up cleanly in public stats. This is strategic resource competition happening in real time, at a scale that's unprecedented in peacetime. And most people have no idea because it's not dramatic. No explosions, no breaking news, just patient, systematic buying, month after month, year after year. If this analysis is resonating, and you're seeing the bigger picture, do me a solid. Smash the like button so the algorithm shows this to more people who need to understand what's happening. And drop a comment. Do you think China's resource strategy succeeds in reshaping global power? How concerned should Western nations be? I read every comment, and your insights genuinely shape future videos. Because Beijing understands something profound that the West is only slowly grasping. Whoever controls critical materials doesn't just participate in the future economy. They control it. They decide who gets to manufacture what. Which countries build advanced industries? Which countries become permanently dependent? That kind of leverage doesn't require military force or political coercion. It comes from owning the physical foundations of industry. And China's moving fast, with decisive speed and deep funding, while Western nations form committees and write reports. By the time those reports are done and budgets get approved and programs launch, China already secured dominant positions across dozens of supply chains. The window for competition is narrowing, and remember what I said earlier. Every ton of copper, every kilogram of lithium, every ounce of silver China buys means converting dollar reserves into physical assets, constant downward pressure on dollar demand. It's erosion of dollar dominance through 1,000 small transactions that add up to a structural shift. Now there's another factor that could accelerate dollar weakness through 2026, and it's coming from a place most people aren't watching closely: Japan. This matters because it's tied to some of the biggest capital flows on Earth. The Bank of Japan has raised interest rates recently and signaled more hikes ahead. Japan's been stuck with a weak yen even after hikes, which is brutal for imports and feeds inflation at home. The central bank is getting forced into more aggressive action because saving the yen becomes top priority, and they've basically made that clear. But Japan has a problem: gross government debt approaching 250% of GDP, one of the highest in the developed world. If they hike aggressively, debt servicing costs can explode, so they need cash from somewhere. And the only realistic source? Selling foreign assets, especially U.S. treasuries. Japan is one of the largest foreign holders of U.S. government debt, over $1 trillion in treasuries. If they unwind even part of that to fund policy and defend the currency, that's pressure on U.S. bond markets, and by extension, the dollar. But that's only half the Japan story. The other half is the yen carry trade unwind. For people unfamiliar, The yen carry trade has been one of the biggest, most profitable trades in global finance for more than a decade. You borrow yen at very low rates, convert to dollars, buy higher-yielding U.S. assets, treasuries, corporate bonds, stocks, pocket the rate differential. With leverage, returns can be huge. That trade pumped enormous capital into U.S. markets for years, supporting asset prices, keeping yields lower than they otherwise would be. But it only works when Japanese rates stay low and the yen stays weak or stable. As Japanese rates rise, the math breaks. The interest gap narrows, profit shrinks, and more importantly, the risk profile gets ugly. Because if the yen strengthens, you have to repay yen loans in a stronger currency, meaning what you owe in dollar terms just jumped. Meanwhile, U.S. assets you bought could be falling if U.S. markets correct. You lose on both sides, double impact, and it can wipe out years of gains instantly. Every sophisticated fund manager in that trade understands the risk is getting extreme. The prudent move is to exit. And that exit means money flowing out of U.S. assets, selling pressure on U.S. bonds, reduced demand for dollars. And it's happening at the same time as everything else we discussed. These aren't isolated events. They reinforce each other. They compound. So now zoom out. Connect the whole picture. China is converting massive dollar reserves into industrial metals, rare earths, and critical materials, while building trade systems increasingly denominated in RMB. The dollar is in a structural down cycle that historically can last 5 years or more. Japan may be forced to sell treasuries, and we're watching the carry trade unwind that supported U.S. assets for over a decade. Global trade patterns shift away from dollar settlement. Strategic resources rise in importance relative to fiat currency. These factors don't just add together, they multiply. They create feedback loops, and the U.S. will likely need to debase the dollar further through more money creation to fund its own belated stockpiling of critical materials. More dollars in the system. 2 superpowers competing for finite physical resources, both strategies pushing sustained downward pressure on dollar value. We're watching a shift in how wealth is stored and how power is projected. Paper currencies steadily lose relative value, while physical resources and strategic materials gain importance. 2026 is setting up to be volatile for dollar holders and anyone with significant wealth tied to dollar-based assets. The reserve currency faces multiple structural headwinds at once. Not like previous cycles where one big cause dominated. This time it's 4 or 5 major forces hitting together. And mainstream finance tends to underestimate how these forces multiply when they converge. Wall Street loves boxes. Trade policy box, monetary policy box, geopolitics box. But complex systems don't work like that. Everything affects everything else. The real action is in the interactions. This isn't just another market cycle that reverses when the Fed changes tone or a trade deal gets signed. This looks more like a generational shift in the structure of the global financial system, the post-World War II framework getting challenged not by invasion, but by patient economic positioning. China played the long game for decades, accumulating the physical foundations of industrial power. The West focused on financial engineering and asset price inflation. Japan is getting pushed by circumstances to prioritize yen stability over feeding capital into U.S. markets. And the dollar is stuck in the middle of forces it can't easily rate hike away. So what does this mean for you personally? If you're holding serious wealth in dollars or dollar-denominated assets, the assumptions that worked for the last 50 years might not work for the next 50. It means real physical assets. Tangible resources and strategic materials may become more valuable over time relative to paper currency. It means we're entering a period of monetary instability where traditional safe havens might behave differently than history books suggest. It means diversification isn't just more stocks or more bonds. It's across asset classes and maybe even currencies. It means the rules are changing, and the change is driven by forces bigger than any single central bank or government can fully control. So tell me in the comments what you think. Does China's industrial metals stockpiling succeed in reshaping global power? Can the US dollar maintain reserve status through this transition? Or are we watching the shift toward a multipolar currency system? And how are you positioning your finances for what could be a turbulent 5 to 10 years? These are some of the most important economic questions of our time. Decisions made now by governments, central banks, and individual investors echo for decades. Stay safe out there, stay informed, and remember, knowledge and understanding are your best defense in periods of uncertainty and transition. If this deep analysis helped you see what's happening beneath the headlines, share this video with someone you care about. Friends, family, colleagues, anyone trying to protect their financial future. And make sure you're subscribed, because I'm tracking these structural shifts in real time and telling you the truth as I see it, based on evidence and research, not corporate narratives. Thanks for watching. Thanks for engaging. And I'll see you in the next video. Because trust me, this story is far from over. Arbtown.